Welcome to This Explainer. Today, we're diving straight into the underwriter's desk to uncover a secret report that is quietly dictating your trucking business's entire financial future. You know, every single year, trucking companies bleed millions of dollars in excess premiums, simply because they don't fully grasp how insurance companies actually grade them. Let's be real. If you're operating a fleet right now, mastering this hidden metric isn't just a helpful tip, it is absolutely vital to your financial survival. What even is a loss run? When a new trucking authority applies for coverage, agents almost immediately ask for this specific document, leaving a lot of new truckers scratching their heads, asking this exact question. It sounds like confusing industry jargon meant to keep you in the dark, but it's actually the single most important piece of paper attached to your business name. So let's clear up exactly how this document controls your costs. All right, so a loss run is basically your trucking company's insurance claims history report. Think of it as a permanent report card for your operations. Experienced truckers know that underwriters use this historical data to predict your exact future risk. Just like a report card tracks your grades over a semester, a loss run meticulously tracks every single penny you've ever cost an insurance company. To an underwriter, your past claims are the ultimate predictor of your future liabilities. So what exactly shows up on this report card? Well, we're looking at claim dates and types, detailed accident descriptions, the payout status, like whether a claim is open or closed, the actual claim amounts, and your overall claim frequency. Underwriters aren't just glancing at a bottom line dollar amount. They dig deep into this granular data to build a complete psychological and operational profile of how your company behaves out there on the road, aggressively searching for any hidden warning signs. $480,000. It is honestly shocking how fast things can escalate to a massive number like this. One standard rear-end accident, a couple of minor cargo claims, and a single workers' comp claim can easily total almost $500,000. When you factor in the hidden costs, prolonged litigation fees, third-party medical evals, equipment replacement, that seemingly small string of bad luck instantly flags your operation as a severe liability. Now, there's a really fascinating paradox when it comes to premium costs and loss history. New authorities without any historical data, they are initially priced exactly like high-risk companies. Why? Because without a documented report card, insurers face this terrifying uncertainty. They simply have no idea if you're a meticulous safety professional or a rolling disaster. And in the high-stakes world of commercial insurance, the unknown is always priced at a massive premium. Frequency versus severity. Every single claim on your permanent record gets dropped into one of these two fiercely debated categories. Understanding how insurers weigh these two unique factors against each other is basically the ultimate key to mastering your insurance profile and taking back control of your long-term operating costs. So underwriters constantly have to weigh the death by 1,000 cuts of frequency, many small accidents, minor cargo damage, constant roadside incidents, against severity, which is your one catastrophic lawsuit, a fatal crash, or a multi-million-dollar payout. A pattern of, say, 3 minor mirror strikes in a single year might not cost a lot today, but it tells a very specific story about driver negligence that absolutely terrifies the people calculating your premiums. Small claims don't matter. There is this dangerous myth floating around the industry that a scraped bumper won't hurt you, but underwriters see those frequent small incidents as a clear symptom of deep operational instability. To an insurer, a driver who constantly backs into fences or curbs is really just carelessly warming up to eventually back into something much, much more expensive. $3.2 million. On the severity side, the numbers are just staggering. A single fatal crash lawsuit can easily result in a massive settlement like this. That is a permanent financial stain. Insurers use long-term multiplier algorithms that punish this level of severity for 5 to 10 years. That forces underwriters to treat your company with extreme caution for a full decade. And this severe caution? It's totally driven by the modern reality of the nuclear verdict. We're talking about catastrophic jury awards of $10 million or more that literally terrify modern insurers. The sheer fear of these massive company bankrupting payouts dramatically dictates underwriting strategy across the entire industry. It even trickles down to impact the base premiums of the absolute safest fleets on the road today. Because of all this, open claims create terrifying uncertainty for insurers since the final payout is just unknown. When an underwriter sees a claim file that hasn't been finalized and closed out, their imagination just runs wild. That pending lawsuit might result in a tiny $3,000 settlement, sure, but it also has the potential to eventually balloon into the next nuclear verdict. And because insurers have to prepare for the worst, that uncertainty equals drastically higher premiums for you. Let's talk about the long-term consequences, because you simply cannot outrun your loss runs. Rebranding your company, changing your DOT number, switching insurance agents, none of that wipes the slate clean. This history follows you everywhere because insurance companies share this data extensively through massive national databases designed specifically to track high-risk operators.
Insurance companies don't just care about how you're operating today. They look back to year 1 when an accident occurs, study the historical trends through year 3, all to lock in your premium for year 5. They're searching this timeline for deeply ingrained patterns and long-term consistency. A bad string of accidents in year 1 acts like a heavy anchor, literally dictating the elevated premiums you're forced to pay years down the road.
$128,000. The financial shock value is very real when renewals roll around. One carrier actually saw their premium explode from $55,000 to this incredible number in a single renewal cycle. And this wasn't even due to major fatalities. It was just 2 standard injury accidents in a 24-month period. It proves exactly how quickly profit margins are completely destroyed by this math.
So underwriters are specifically trained to hunt for distinct red flags. Frequent cargo claims, like repeated reefer spoilage, signal poor equipment maintenance. Workers' comp injuries signal a terribly weak safety culture. And late claims filed right before renewal, that strips away an insurer's ability to set aside proper cash reserves, which usually makes them panic and defensively spike your rates just to protect themselves.
If your loss history looks worse than average fleets of a similar size, standard insurers will simply refuse to renew your policy altogether. This forces you straight into the dreaded high-risk surplus market. When you land in this tier, you're facing strict operating radius limits, completely excluded cargo classes, massive deductibles, and overall costs that can easily double overnight. It's rough. And honestly, the damage extends way beyond just paying more for insurance. A poor loss history actively causes major revenue loss because it reduces your load opportunities and premium freight access. Smart freight brokers meticulously review your safety records before trusting you with their high-value freight. If your loss runs paint a picture of instability, you're going to be permanently locked out of the best, highest-paying dedicated load opportunities. Protecting your future. Okay, you aren't helpless in this equation. Now that we thoroughly understand the grading rubric the industry uses against you, let's focus on how you can actively protect your financial future, take control of your risk profile, and keep that permanent report card meticulously clean. First things first, you've got to stop making these 4 incredibly common mistakes. Truckers frequently file minor claims out of convenience, not realizing the long-term premium spike will cost them triple what they saved by not paying out of pocket. Ignoring the root safety problems is even worse. Maintaining weak documentation, well, that speaks for itself. But the most dangerous assumption of all is thinking your history just quickly disappears if you wait a few months. Smart operations don't just react to accidents. They proactively protect their loss runs. Focus heavily on a culture of safety. Train your drivers continuously. Maintain your equipment properly. Install and utilize dash cams. And investigate all incidents internally. Actually, conducting your own thorough internal investigations into every single minor incident proves to cautious underwriters that you're an active partner in risk management, rather than just a passive liability. I really want to highlight that dash cams fight false claims, defend drivers, and prevent unnecessary payouts. They are absolutely your best line of defense. In a legal landscape totally terrified by nuclear verdicts, a simple piece of objective, high-definition video evidence can stop a fraudulent, multi-million-dollar claim dead in its tracks. Proving you were not at fault keeps that massive payout off your permanent record forever. Most truckers only realize the importance of loss runs after premiums explode. There is a harsh, unforgiving reality in this business, and that quote hits the nail on the head. Please, don't be the carrier that learns this lesson too late. Do not wait until a renewal quote literally threatens to bankrupt your operation before you finally start paying attention to your historical data. At the end of the day, protecting your loss history is protecting your future business. A pristine loss history isn't just about saving a few bucks on commercial insurance. It acts as your ultimate competitive weapon. It is your concrete industry reputation. Protecting it actively unlocks those premium freight contracts and significantly lower operating costs that your high-risk competitors simply can't access. So I'll leave you with this final thought. Would underwriters trust your operation? Take a hard, honest look at your daily habits, your drivers, and your underlying safety culture today.
If an underwriter looked at your real, unfiltered report card right now, what would they see? Thanks for joining me on this explainer. Take control of your history before it takes control of you.